Hi everyone, and welcome back. You're watching The Money Show on ET Now. Well, if you were listening in just a short while ago, we had a very brief conversation with Mr. Harsh Rungta, on value funds, and that's the topic that we are going to take forward. We have with us a very special guest. Let me introduce Meenakshi Dawar, the fund manager for equity investments with Nippon India Mutual Fund. And the fund that we'd like to discuss today is, of course, the Nippon India Value Fund, which Meenakshi manages. So thank you so much for joining us today on ET Now and on The Money Show. Meenakshi, let's start off first, before we delve more into the Nippon India Value Fund and, value fund as a strategy, what it's been doing for investors. Let's talk a bit about the Nippon India Value Fund. Where does it invest? How does it invest? What's your investment strategy for this fund?
So, as the name of the fund suggests, the fund follows value-based investing. So what does value-based investing means is that you are going to invest in good businesses, but at the same time, the price that you pay for those businesses is also equally important for you. So you are not going to buy any business at any price. The valuation, the price that you pay for it is also really important for you. So therefore, our focus in this fund is to focus more on the long-term sustainable value of the businesses rather than getting too influenced by what is happening in the short term. So whenever anything that we buy in the portfolio, we build in a lot of margin of safety in terms of what price are we paying in for that particular stock. And also when we buy it, we are going to buy it for long-term structural play rather than playing, near-term 1 or 2 years of earning cycle. So that's how we like to construct this portfolio in this particular fund. So just to delve a little deeper into it, whenever you invest in any businesses, you basically have to take two types of risks. One is the business risk and the other is the valuation risk. So here in this fund, the first level of screener is definitely investing only in good businesses, good companies. But also you will wait for the right opportunity so that you're not overpaying for those businesses.
All right. So basically looking for a good bargain in the stock market and, getting good value as well. Of course, ensuring you're buying into a good stock story, a business story. If one has to look for a bargain of sorts, then Meenakshi, I'm sure the whole crash that we saw, especially immediately during the coronavirus in March, or rather before, should I say, there was this big loud crash in the equity markets. But since then, there's been a astounding rally as well. How do you think investors in adopting this value investing approach, or let's put it simple for our retail investors who usually use mutual funds, how has it been for them? If you could summarize, how these what we call bargain stocks did between this period of March and December.
See, if you look at it, last 6-7 months, this was a period of very uncertain time for the markets. So, people did not expect that this kind of degrowth or, something like COVID will impact us so sharply. And people also didn't anticipate the recovery that market has shown. So as an investor, what happens is when there is a lot of uncertainty in the market, people tend to stick to certain few explored ideas rather than going very broad-based. And that is what happened in the market in last 6 months, that whichever companies were delivering growth, which had were able to deal with these near-term challenges better, have definitely done better than the broader market. But and that is what has led to so much of outperformance of growth as an investing style over value investing. But if you look at, where we stand right now, so as I said, market tend to price what is happening in the near term to perfection. So if any company has been able to do good growth, has been delivering better, that is already there in the price. So for an investor to make money from here on, it is very important for us to look beyond what is happening in the next 1 or 2 quarters. And therefore, it is very important for you to have a strong fundamental understanding of the business that you're investing in. So if the business is able to survive these cycles of, lower growth, and therefore you are getting a good entry point into these businesses, that is when you make good returns on your investments. So this last 6 months have been into understanding what has been happening in the market. There was so much of uncertainty, and therefore people were sticking to very few ideas. But from here on, as and when the recovery becomes broader based, and a lot of companies which which had disappointed or had been not been able to participate in last 3-4 quarters of growth, as they come back to normalcy, you will see better returns from those names as well. And as I said, that there is enough and more margin of safety which is being built into these names. So as and when the economy become little more broad based, you will see far better returns from these value names.
So actually, I think you've responded to my next question as well. It was essentially regarding this one trend that we witnessed in the last couple of months. In general, investors have sort of been pressing the redeem button on equity mutual funds as a category as a whole, but more specifically in the value fund category, I think it's with a bit more vociferousness that the redemption button is being pressed, because within the value fund category we saw the most amount of net outflow, at least in the month of October. So would you advocate all value fund investors, or for those individuals who do have value funds in their portfolio, would you advocate patience, adopting a long-term approach, as opposed to just looking at the markets and saying, okay, look, they've rallied, and now that I'm a little bit in the green, let me just press the redeem button?
So that's what exactly I was explaining earlier also. So whenever you're doing value-based investing, you have to be a little more patient, because you are not investing for what is happening in the near term. You are investing in what is going to happen and what can happen for next 4 or 5 years. So therefore, it has to be part of your allocation, and then it has to be a long term. You have to enter into this category with a longer term view. And as I said, it is already been a long period of underperformance of value as a strategy over growth, because cost of capital worldwide, it's not an India phenomenon. Cost of capital worldwide has come down, and therefore people tend to pay a lot of premium to the growth. But as and when there is a slight disappointment in growth, or your inflation starts coming back, cost of capital starts increasing, you see lot of catching up, and lot of by the value funds or value as a strategy versus growth. So at this point of time, if you see the valuation gap or the price that you're paying for these businesses is already 40 to 50% lower than what you will be paying for the growth funds. So any reversal of trend happening will give you far better returns in a value strategy than in a growth strategy. So if you have if you will be patient with your investments, this category will definitely revive, because as I said, the margin of safety is pretty high, and market has been chasing growth a lot. Therefore, those mean reversion trades from here on can be very strong.
All right. Okay. Meenakshi, for the Nippon India Value Fund, of course, as we know, the one aspect that you do look at in before you buy a stock is value. But apart from that, what are the other filters of sorts you ensure you put in place so that only good quality stocks enter the fund? Of course, the reason why I ask you this question is because we have seen many a times, especially on the debt side, less so on the equity side, but we have seen NAVs being sort of wiped off because of defaults by certain companies, because of downgrades, so on and so forth. So how do you ensure that you have good quality stocks that enter the portfolio? What are the strict parameters you follow?
Right. So, as I mentioned, the focus here is on valuing very long-term sustainable growth of the company. So, you have to focus a lot on what the company can be in a longer term. For that, the company has to survive on in bad cycles as well. And that is going to be our key focus. So one thing is very important for us is that the company has to be an efficient allocator of capital. So for you to survive bad times, it is very important that you have very strong balance sheet. And in bad times also, you're able to survive by generating decent cash flows and decent ROEs in the business. The third foremost important thing for us is that the business that the company is operating in is a scalable business, and the company has a competitive advantage of remaining in that business. So, like I said, the focus is on buying very good franchisees, very good quality companies, which are going through a very temporary bad phase of growth, and therefore they are available at a very good price to you. So, we will not compromise on the quality of businesses. So a lot of time, like you mentioned, people try to chase value by investing in low PE stocks, and therefore they end up taking lot of risk on the business. So we will not take very high business risk. We will not invest in businesses where there is issue with the terminal growth rate, or there is issue with the, technology or company not being in existence over next 10-15 years. That first and foremost thing is really important to us, that we are investing in good businesses who have capability of delivering growth over a longer period of time.
On that note, thank you so much for joining us today on ET Now and on the Money Show in our Meet Your Fund Manager segment. I'm sure all the investors in value funds, of course your own unit holders as well, have gained a lot from our conversation. And of course you can always catch this entire interview on ET Now's YouTube channel by finding the Money Show playlist. Thanks, Meenakshi.